I'll just take you through our brief view on macro credit. Corporate India remains in fine fettle when measured against various credit matrices. Looking at the past 10 years time frame, we see that the debt servicing metrics of leverage and interest cover have recovered significantly post the dip seen during COVID. And we believe that they are likely to remain comfortable going ahead despite the expected pickup in capital expenditure and M&A activity. The debt-fueled growth mindset has now changed, and companies are looking to prudently use internal accruals and conservative capital structures when planning acquisitions or brownfield, greenfield expansions. The various profitability matrices are also at the highest point seen during the last 10 years, in part enjoying the tailwind of the dip in input costs, and this is likely to sustain over the next 6 months before normalizing in the second half of the year. Hence, the 2:1 upgrade to downgrade ratio that has been seen in September 23 on the back of extremely high credit ratios seen in the last 2 years is testimony to the strong credit profile of various entities that form corporate India. This credit underwriter's dream period dovetails well into the Goldilocks situation we are experiencing in India on the macro side of growth, coupled with a downtrend in inflation. Thus, this dream run with respect to creditworthiness that corporate India is experiencing is expected to continue for some more time. Credit demand has also picked up, and we expect it to continue to grow at an annualized rate of 17% in the next decade. Continued tightness in the dollar markets would lead many corporates who used to borrow abroad now finding domestic borrowing relatively cheaper. With the balanced liquidity now in the banking system and steep rise in the credit deposit ratio of the banks, corporates would need to look outside the banking system to meet their needs. Many large wholesale financing NBFCs have also slowed down their disbursements in this category. So we expect a lot of this high quality, good supply of paper to start feeding into the corporate bond markets. So credit underwriting is extremely good given the creditworthiness of India. And also we have seen that there is a good supply of high quality paper coming into our markets. So how does the third factor, which is credit spreads, actually look like? The huge amount of liquidity that was previously sloshing about the banking system had driven spreads to decadal lows. Corporate bond spreads are finally now showing signs of expanding. So with liquidity expected to remain balanced going forward, a better risk-adjusted return is expected just when the supply of good quality papers is expected to hit the bond markets. All this augurs very well for a relook at high-yielding papers. At Aditya Birla Sun Life Mutual Fund, we continue to prefer cash flow generating companies and sectors with good promoters, a good performance track record and conservative capital structure, and shall accordingly selectively invest in those sectors and companies. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
म्यूचुअल फंड निवेश बाजार के जोखिमों के अधीन है। स्कीम संबंधी सभी दस्तावेजों को ध्यान से पढ़ें।